A good starting point is to think who benefits from the value of the firm. Remember that under the balance sheet identity, growth in asset value on the left-hand side will be matched by growth in the value of debt and equity in the right-hand side. Obviously, the providers of capital to the firm are the shareholders who own the firm and the debt holders who have lent money to the firm. Debt holders lend capital to the firm, and in return they expect payment of interest and repayment of principal upon maturity. While they generally have little say in the day-to-day running of the firm, they do have priority on the firm's cash flows and assets in the event of liquidation. However, these claims are fixed in the sense that they do not grow with the firm. On the other hand, equity holders invest capital in the firm to become shareholders and receive returns on their investments only after creditors are paid in full. Unlike the debt holders, the shareholders' claims to firm value is not fixed and have an unlimited upside. Let's suppose the market value of a firm is measured by its assets and is. What is the conclusion we draw then? Shareholders are better off in terms of wealth as measured by the value of shares they hold if the value of the firm as a whole increases. So managers should maximize the value of the firm. In our example, the value of shares matches the value of the firm. This will only happen if markets are fully efficient, that is, the true value of the firm is the same as the market's assessment of the value of the firm. Debt reduces shareholders' wealth because equity holders only have a residual claim on the firm's assets. Accordingly, shareholders will only benefit from the use of debt if it increases the value of the firm. The implication is that managers should only issue debt if the firm increases firm value. So what should be the objective or the goal of the financial manager? Is it survival? Is it avoid financial distress? Or is it beat the competition? Or is it maximizing profits or minimizing costs? If the goal is to minimize costs, then the firm can minimize costs today by not purchasing new equipment or delaying maintenance, but this may not be in the best interest of the firm or its owners. Or if the goal is to maximize profit, should the firm concentrate on long-term or short-term profits? Is it accounting profits or some measure of cash flow? And here we differentiate between maximizing profits and maximizing wealth. Wealth is maximized when share value is maximized. This is related to the size, timing, and risk of the firm's future cash flows. Profit maximization ignores these three items. Most of these goals present problems as they are either associated with increasing profitability or reducing risk. They are not bad, but they are intermediate objective functions. They may assist us in increasing firm value, but they are not the final objective. If they are correlated with the long-term value of the company, they work well. If they do not, the firm can end up in bad shape. Therefore, the goal of the corporation should be to maximize the shareholders' wealth as measured by the market price of a company's shares. A company's share price reflects the timing, magnitude, and the risk of the cash flows that investors expect a company to generate over time. There is no conflict about the short run versus long run here. The purpose of a business should be to make money for its owners. Maximizing the current share price translates to more money for the owners. If the firm does not have publicly traded shares, then the goal should be to maximize the owner's equity of the firm. Non-profit organizations can also follow the same principle, but their owners are the community or the people they were created to help. Does it mean that we should do anything and everything to maximize owners' wealth? This is where ethics comes into place. Some people might say that as long as share value is maximized, it doesn't matter that the product your company is selling is made in the third world country by children working 12 hours a day for a few cents. I think it all comes down to choice. Do you want to own shares in such companies? Do you want to be the financial manager in charge when you have to deal with issues like this? This is a huge conflict for the financial manager and not an easy one to answer. In our simple firm model, the parties most obviously interested in the behavior of the firm are shareholders and debt holders. In reality, there are many stakeholders in the firm. These include employees, customers, suppliers, the government, the communities in which the companies operate, environmental groups, etc. Given it is unlikely that their interests will align, firms must manage these stakeholders group within the primary goal of maximizing shareholders' wealth. Managers may care what the interests of these groups are, to the extent that their actions may affect firm maximization value. In the next section, we look at how conflicts are managed in theory and in practice between several of these stakeholders: shareholders, debt holders, managers, financial markets, and society as a whole. So this is the big picture. Shareholders hire the managers through the board decisions and annual meetings, and in turn, managers have the duty of maximizing the shareholders' wealth. Bondholders or debt holders lend capital to the firm, and in turn, managers or the firm must protect their interests by ensuring they receive their money back. Financial markets are supposed to be efficient and are supposed to value assets and firms correctly at their proper value, and in turn, managers must reveal information honestly and on time to enable the valuation process. And society should be able to trace costs, if any, easily back to the firm. However, the firms should not bear any cost to the society. In reality, however, things are different. Shareholders have little control over managers, and most of the time managers don't act in the best interests of the shareholders. When bondholders lend to the firm, there is a chance that they will lose their capital if the firm goes insolvent, and in the end they will not get their money back. Markets can make mistakes by incorrectly valuing a firm's assets, and because investors are irrational, markets can overreact to certain events. In turn, managers delay bad news and sometimes even release misleading information about the company. Some firms can produce significant costs to the society, and in turn society is sometimes helpless as it cannot trace those costs to the specific firms who make those costs.